The next slide is page 42, and I put this slide together intentionally years ago because it powerfully addressed the question a young client had when I brought up the idea of long-term care. He was approximately 50 years of age, and he said, Bill, he said, I don't expect to be in a nursing home until I'm well into my 80s. And he said, I don't see any reason whatsoever to spend this kind of money on this kind of a benefit. So I took an average amount for policies when this slide was put together and indicated that at a cost of $1,169 per year, paid for 31 years before he reached age 81, he would have basically invested over $36,000. I wanted to make this point because I wanted to make it easy for him. I said currently stays in nursing homes run anywhere from $60,000 to $100,000 a year. So the amount of money you would have spent over all those years for that policy will probably pay into the future less than a couple months of coverage. Secondly, you'd have no idea what might happen to you as the years go by over a 31-year time frame. And I said the only important thing that you have to do is you have to make sure that within at least 60 days before you have a car accident that disables you, you have a stroke or a heart attack, or you develop cancer, that you call us. We'll get an application completed, get a policy issued, and then you're all set. But you've got to give us at least 60 and probably 90 days. So do some advanced planning mentally and think that through. I said the alternative is you're protecting yourself and your financial future if you spend this small amount of money each year.
Of course, Bill, if the illness that you're worried about is either dementia or Alzheimer's, they may forget to tell you that ahead of time.
No question about it, Bob. Excellent point. So it's simply a way to get the client to reframe their thinking in terms of what they should be doing to protect themselves. And it gives you an out because you brought it up, you've shown them, and it's their responsibility at that point. Make sure you keep your records. Everything we do with clients is scanned into our systems permanently. You'll also notice on the top of these different slides that we mentioned go to our online site, longtermcarebooks.com. Slides will be updated on that site, especially tax issues and changes in different Medicare funding as they come available. And that will take probably 6 months for us to get that up on the site, but this will be a resource for you. There will also be sales ideas up on that site eventually just for advisors, and we'll get that set up separately. Figure 9.2, the next slide on page 73, addresses the issue of the long-term care premium deductions allowed under tax law currently. Now you need to understand that these are deductions that are based on age restrictions and do change year by year, as you can see, between 2007 and 2008. And these are deductions that are subject to the 7.5% medical deduction that takes place on your estimated expenses that you can take as deductions. It is not a page 1 deduction automatically. We find that probably 85 to 95% of all seniors do not qualify to actually get a benefit from this unless some very serious tax planning is undertaken. And you need to understand the difference between tax qualified and non-tax qualified policies in terms not only of this issue, but access to benefits. So keep this in mind when you're talking with clients. They may not benefit from it, so don't make it an automatic assumption.
In other words, just to clarify, this is the amount that they can include in their medical expenses to see whether or not they exceed 7.5% of adjusted gross income.
When added to their other medical expenses, that's exactly right, Bob.
Other uninsured medical expenses.
Precisely. We now move into, this is Chapter 10, and this is the chapter entitled Insuring Your IRA Account. And I have found over the last few years, because I work very closely with Ed Slott and his IRA advisory practice out of New York, that when we get into the subject of people looking at an IRA account and we say to them, is your IRA account insured? We get a stunned look on the faces of our prospective clients, or they kind of smile and think I'm kidding, or they truly don't know what we're talking about. So what we did was to put together a series of slides which you're going to see here, which are really opportunities to help you close an insurance sale depending on the kind of sale that you're trying to achieve. In the first case, and in several of the cases as we go through this, we simply took the example of a $1 million IRA account in which both a husband and wife would benefit from that account, and assumed they were age 65. We further assumed that they had not bought any kind of long-term care policy. When sitting with a prospect in this situation, which is fairly common, with this amount of money or more, they will smugly look at you when you talk about long-term care and say, I don't need it because I have this account that I can rely on. And I always step back for a moment and say to the prospect, sir, in the case of your situation, if you went to a nursing home, you most likely would spend about $8,000 to $10,000 a month, $100,000 to $120,000 a year. And they'll usually nod their heads and not seem very concerned about it. And I turn to the spouse and I say, what happens to you? And if I use the same scenario with that person, what you're looking at is the potential to wipe out this account in less than 4 or 5 years. All of a sudden, they are not quite so smug about their position, and they want to know a little bit more about what I'm talking about. And what I did in this first case was to simply say, if we purchase 2 long-term care policies for a husband and wife with all the discounts that apply, and if it did cost in the range of $8,000 a year, and there are many ways to structure these, what would really happen? What we're taking out of that account each year is obviously taxable money. So in reality, they're probably taking, if they needed to, $10,000 to $11,000 to pay for the taxes, but there may be an offset of the tax deduction on their tax return for the purchase of the policy. In addition, they have protected the IRA from ever needing to be accessed for this cost up to the limits of the policy. And what happens in that situation is the client realizes you really do care about solving a problem for them that they had not considered, or in the alternative that they had refused to accept as something that is going to happen, as we already know, to 30 to 40% of the population over time.
I think that's brilliant, Bill. I think that to bring out the consequences to the things they're depending on for income later in life is just wonderful.
Thank you, Bob. This next slide is page 78, and you'll see it says first item. There is another one we'll look at in a moment. It is figure 10.2. In this case, we talk about purchasing life insurance with a long-term care rider. Prior to working with Provada several years ago, I had come across this product in the marketplace and had been offering it to my clients. Once I joined forces with Provada and found the full range of benefits of their knowledge base and the products that they had available, this became a very significant part of our business. And what I do with clients in this situation is I give them a scenario which I try to make as accurate as possible. And going back to the case of the husband and wife again, with that account, I will say to the couple, you really have 3 choices in this situation to determine whether you're going to cover long-term care with some other kind of insurance protection or you're going to handle it yourself. And I say in the first case, if you handle it yourself, we already know that you could very well completely exhaust your IRA account in a 5 to 10 year period if something catastrophic happened to both of you. Even if it happened to one of you, it's potentially possible. I've had clients go over $250,000 in total expenses in less than a year. So that's the first choice. Do it yourself. The second choice, as I already pointed out, is to buy a long-term care policy. I have to tell them, I want to make sure you always tell them, long-term care policies can be adjusted for premium cost into the future, and the history of the industry has been, in most cases, companies have done that. And as a consequence of that happening, some of these have been egregious increases of as much as 600% over time. And many people have to give up the policy before they ever even use it. So I point that out. And I say your third alternative is to purchase life insurance policies, if they have the financial wherewithal, that have long-term care riders as part of the coverage. Now, different companies have different ways of handling this, but one of the companies, John Hancock, that we frequently use, has both a variable and a universal life policy that provides a long-term care attachment or rider to the policy. And you can get as much as 200% of the death benefit with an optional rider, and at the same time get a series of different payouts based on your actual expenses. And I think maybe at this point I'm going to have Bob just talk about the mechanics of the policy. But please keep in mind that if you do it this way, this is not tax deductible, nor is the rider cost within the policy tax deductible.
Thanks, Bill. Well, a couple of comments there. I've heard a number of potential clients of our brokers say that, well, if I don't ever need long-term care, I've spent all this money on my long-term care insurance and I never get anything back. That seems to me a strange reaction, because that's true of your homeowner's insurance if you never have a fire or whatever. It's true of your automobile insurance. These are things that you buy because you need them, and we really hope all the time that you never need them. And that's true of your long-term care policy. We hope you never need it. But if you do need it, it's great to have it. And one of the benefits of the type of policy Bill is talking about here, which is the life insurance policy with a long-term rider, is you will get paid one way or another. To the extent you have drawn down the benefits for long-term care during lifetime, your death benefit goes down and perhaps disappears altogether. But if you do not need the care during lifetime, then the full death benefit is there for your family. Typically, it is not out of the estate because you want to keep the long-term care benefits for yourself. But we're working on an idea which we believe will work very well, and we will be sending out an announcement on it very soon that will help to keep at least part of it out of the estate. But please make sure you contact me and not Bill if you have questions about this policy, because he's a busy guy and that's what we're there for.
Thank you, Bob. And I would point out to you that when you talk about a policy of this type, you need to really understand the tax consequences of the benefits, because whether it's a long-term care benefit being paid out or a death benefit, income tax-wise, the tax consequence in most cases, almost 100% of the time, will be zero. So it's a very powerful alternative. And I find, and have found over time, that 75 to 80% of the cases that start out as a consequence of the policy being structured this way, they will purchase this versus the first two options that I have described to you. I also want to point out to you that I mentioned this to an advisor with Provada about a year and a half ago, and from my understanding, a very significant policy of life insurance with long-term care as well as a long-term care policy were sold to a husband and wife with a net worth, I believe, well over $25 million. I never hesitate to bring this up with wealthy people. Wealthy people understand financial risk, and they want to transfer risk when they can do so, when they can afford to do so, because they understand that they do not want to have to pay for this, and this is a way to avoid it completely. The next slide is page 78, the second item, and again this talks about purchasing life insurance, but this is using an accelerated benefit rider. If you feel your client really will not be agreeable to purchasing the long-term care rider, which is not that expensive, but you should understand it's available, this might be another alternative, because almost all insurance companies in the country today offer this. But as Bob and I have talked in the past, it is a rider that you usually have to check off and make sure the client understands it. And it normally is only available to pay for these kinds of expenses in the last 12 to 24 months of life. And in many cases, the benefit is subject to interest costs, and it also reduces the death benefit, as does the life with long-term care.
Almost every carrier offers this benefit under, sometimes it's called a terminal illness rider, sometimes an accelerated benefits rider, sometimes a living benefits rider. And we see an awful lot of applications coming through our office where it is not checked off. And I don't really understand that, because it doesn't cost anything and it just adds flexibility. So I encourage everybody to use it.
Our next slide talks about the ownership issues of long-term care policies. This is on page 79 in the book. What I would encourage you to do is to look this over carefully so that you do understand it, and go back to Bob and the team at Provada, because he has some excellent ideas, and he's got a separate idea that's going to be sent out in an email later on concerning how to own these policies properly between a husband and wife. About